Thank you very much, and thank you to the Mining Journal for having me here today to deliver the Argonaut gold story. For those of you who don't know Argonaut, we're a producing company with 3 operating mines and 3 development projects. Given the limited time, I'm going to move through pretty quick, and I was probably aggressive, but I booked a meeting with myself upstairs in 10 minutes, so I'm going to try and get us back on time. Argonaut Gold, I consider us the safe gold leverage play. And when I say the safe gold leverage play is because our leverage comes through operational leverage and leverage from ounces that we have in the ground through our existing mineral reserves that are not yet in production. 60% of our reserves are not yet in production through those 3 development projects. We're not levered through financial means. We keep a very strong balance sheet. And I think when we look at the history of the company, we were founded in 2010, and the goal of the company was to become a 300,000 to 500,000 ounce producer. I can say today, this year we're going to do over 200,000 ounces. We're 2/3 of the way there, and we've taken the slow and steady approach to doing so. We've delivered over 1 million ounces of production since we founded the company in 2010. And the reason we want to get to this 300,000 to 500,000 ounce level is we feel much beyond that the treadmill starts getting too fast and it's hard to replace your production level. And at that level, when we looked at this business, when the company was founded, we looked at if we have $1,200 gold and we can keep our all-in sustaining costs at $950 or less, we're going to generate significant free cash flow where then we can fund our exploration programs to replace our reserves. We can build cash on the balance sheet to be able to build our new mines that are coming on to replace production as mines close in the future. And we'll have enough cash left over to start returning capital to shareholders. That's the goal of the company, and as I said, we're 2/3 on our way. And if you just look at the last 3 years here, we've quietly, during a down market, been able to grow our production base 65%. And I think what's really interesting about this, it is the slower and steadier way to get there, but we've done it with a clean balance sheet. We have 14 million net cash, 28 million cash in the balance sheet, only 14 million drawn on our revolver, and only 178 million shares outstanding. This company was founded in 2010. We have never, in the history of the company, issued a common share that wasn't used for M&A purposes. So we're not a company that comes back and has our hand out to the market. When we build a mine, we build up cash on our balance sheet through operations, and then we take on a reasonable amount of financial leverage, as we drew on our revolver here to build our last mine, and then we do it through cash in the balance sheet. So it's the old-fashioned way. We're running a real business here, and I'm excited about where we're going. Our producing assets, you can see here the red dots, we're producing all 3 mines in Mexico. Our El Castillo complex is 2 mines. They're about 10 kilometers apart, our El Castillo mine and our San Agustin mine, as well as our La Colorada mine up in Sonora. 2 other development projects in Mexico, San Antonio, which sits in the Baja California Sur, and our Saratoga project, and I'll get into these assets a little bit later. And then, of course, our Magino asset up in Canada, which is we view as a very strategic asset, all resource categories, over 5 million ounces in that deposit. When we look at the production here at the El Castillo complex, we have a history here. We've produced about just over 3/4 of a million ounces through the complex to date. We're going to do 140,000 to 150,000 ounces at this complex this year. One of the big things going on at our San Agustin mine this year is we're making a $15 million investment to increase the crushing throughput rate from 20,000 to 30,000 tons per day. So at that mine, we're increasing production 50%. That'll be in place here in the second half of this year. La Colorada, this year we'll do 60,000 to 65,000 ounces. So consolidated over 200,000 ounces of production, which, as I'll speak to in a few moments, really I think puts us in the next category in terms of valuation. Right now, I don't believe that we're getting much, if any, value in our share price today for our development asset portfolio. All 3 assets, I think, are strategic in nature, and none more so than our Magino mine, past producing mine up in Canada. This project sits right next to Alamos's Island Gold Mine, formerly owned by Richemont Gold. You can see the blue line there separating the property. We have a feasibility study done on this project 17-year mine life, 20% after-tax rate of return at $1,250 gold, $290 million NPV, at 5% discount. If you plug in $1,400 gold where we're sitting today, that NPV jumps up over $430 million. On this project at Magino, we've just received in the first quarter of this year both the federal and provincial environmental permitting. So that really opens the floodgates to all your construction permits and things you need there. The capital for this project is a little bit beyond our reach ourselves, or what we would do ourselves is $320 million. So for us, we'll entertain the ideas of partnerships, and internally, let's get this project warm and ready to go, and we'll see where the market is when we're there. For our other development assets, Saratoga, this is an interesting asset. It's right down the middle of the fairway of what we've done well. Argonaut, we operate heap leach projects in Mexico. Saratoga is another one of these projects. We picked this project up at the end of 2017 for $15 million cash. It was a distressed situation. The previous company who had this had different market environment at the time, but when they had acquired this asset back in 2012, they had acquired it for $120 million value in shares, and they'd put $30 million into the ground, developing this project, tying up all the land, all the water, exploration drilling, as well as a feasibility study. So their numbers and not ours. We're coming out with our own preliminary feasibility study later this year, but their numbers, they saw a project that was about $150 million capital, cash cost just over $500 per ounce, with after-tax NPV 6% discount at $180 million. So what I like about this project, it's right down the middle of the fairway of what we've done well. It's in Mexico. It's a heap leach project. It's a project that we were able to come into for only $15 million, and in a very short time, in less than 2 years, we'll be able to deliver our own economics on this project and let the world know how we view it. Our San Antonio project, this is by far the best asset in our portfolio from a rate of return perspective, over 60%, only $85 million in capital for $200 million NPV, 15-year mine. The issue we've had with this project is where it's located in the Baja California Sur. It's not a prevalent mining area. We've been working on permitting on this one for quite some time. We, in the past, had a zoning issue that now has been taken care of, and the whole project is now zoned for mining. We refiled our environmental permits applications here in February of this year, and we should have some results on that by the end of this year. And when I look at the potential re-rate potential for this stock, I look at the two clusters here that we see. We were producing in this 100 to 150,000 ounce range for quite some time. We built our San Agustin mine in 2017. We're continuing to ramp that up with an expansion this year from 20,000 to 30,000 ton per day. As that moves forward, and we can show this year that we deliver over 200,000 ounces of production, we're confident that we should see a re-rate. If you look at enterprise values of companies along this graph based on production rating. So what we see is right now we're still being valued as a smaller producer, but as we continue to deliver that, Q4 last year was our first quarter over 50,000 ounces of production. Again, Q1, 54,000 ounce production. So I think if we can deliver a few more quarters here, we'll see that through. The other catalyst with Magino, as I said, we received the environmental permits this year. So we're continuing the permitting on that project, and we'll explore potential partnerships to see what the best way is to move that project forward. Saratoga, we've submitted our permits on that project, and we should have a pre-feasibility coming out here before the end of the year. And San Antonio, again, we should have an answer on where we stand with our environmental permitting by the end of the year as well. So our focus this year is really simple. We plan to build the balance sheet. We added $11.7 million in free cash to the balance sheet in the first quarter. Continue to de-risk the development projects, which I would argue there's no value for today in the stock, as well as deliver our first year and a record year of over 200,000 ounces of production. And just because I've gone through that really quick, I will just point out one more slide. If you look at the analyst consensus and the value for our assets, and then the value we're receiving in the market today, we're receiving today, if I was up this was done a couple weeks ago, but I was updated, we're receiving about $250 million of value today in the market. If you look at only our operating assets and our net cash position, that's $300 million of value. So we have a $50 million value that we should be able to close here just by executing, as well as if you look at these development assets where the consensus are versus where the technical reports show, there's a lot of value we can add through as we continue to de-risk these assets and move them closer to production. So that was the quick version, and I have to run upstairs to a meeting. I'm going to be upstairs at stall number 4 today. I'd welcome anyone to stop by at any time, and I'd be happy to chat further. Thank you very much.